Welcome back. We're just getting the earnings results in from Celestica at this hour. We're sharing them with Geoff Barratt. He's the general partner, Barratt Holdings, as we discuss the numbers. So Celestica, first quarter just coming in. We have earnings per share at $1.20. The estimate had been $1.12, so a beat on that. And then we have revenue coming in at $2.65 billion, so a 20% jump year over year. The estimate had been for $2.56 billion. Your first read, Geoff?
Yeah. So, look, I haven't liked this company for a bit, and I wouldn't say it's because they're the numbers that they're printing. And so this company prints. It's a data center recipient, and it's a thin margin business. So the stock is trading at a 20-year high, which you have to go back to 2000, a 25-year high to get to these levels. And it's typically a 4% operating margin business, and it's doing something like 7 now, and that's what they're guiding. And so they'll be the last to know if data center activity softens. And the stock really ran. I got shorted. I'm not shorted now. And it paid off pretty well because I think it peaked out in U.S. at like 140 or some crazy number. And it was just too momentum based, and the multiple had gone up to all-time highs. I feel that the risk to this business is down and not up. I'm sure they're putting up great numbers now. You can see it in the report. But the question is, do we get a quarter where suddenly AI and data center deliveries are softer in the guidance? And that would break this stock and send it potentially down to like $50.
Okay.
And so that's what I'm watching for. And so I think you have to be tactical on it because the stock tends to spike a lot, but I tend to get shorted when it gets aggressive. And look, there's nothing in this report that would say, oh my God, this is a bad story, because it's not. But there's real risk in it that I think people aren't pricing in and don't factor in. And at the end of the day, this is not a business with a great moat around it. This is a business that is a contract manufacturer, so they have no pricing power. And I worry that somehow impacts their margins eventually. And so that's how I think about it. It's just, of all the businesses you could own, it's not on the top of my list, and I don't think Warren Buffett would put it on the top of his list. So,
okay, talk to me a little bit more about, you mentioned, of course, the data center concerns and build-outs there, but what about just the bigger environment with Donald Trump and the tariffs? Do they have any exposure that way as well, to the tariffs with China? Yeah,
look, it's an uncertainty. I've definitely done some work on it. It's a great question. Most of their plants are in the United States, but they do get parts from Asia. And so you're right to say that there's potential tariff risk in this business as people feed parts into their business. And so I do worry about that, increasing their costs and bringing their margins down. We talked about it being a thin margin business. It doesn't take a lot to break the profitability of this company. So I think it's a great question.
We've had the CEO sell a lot of shares recently, taking advantage of the upswing. What does that tell you, or does that make investors nervous that it has reached sort of where it was aiming to reach?
To me, it does. It's a red light if the CEO is selling and it's not on a program. That is a huge flashing red light. And I think, look, I speak to a lot of people in the community. You know, Paul Sabourin and I talk, and I think we both think that, and maybe if we looked out a couple of years, there might be a lot of data centers operating at 50% of capacity. We've seen this with the optical build-out in the early 2000s because we've been around for a while. And I think this is no different than that.
Okay, so I just want to widen that out a little bit with you, because I'm wondering how far into the cycle you think we are. It almost feels like we are still early in the cycle, and that's what we're hearing from some people. But you're saying, we're a little bit farther along than we think we are.
I'd say 2 points.
Okay.
So I'd say one, what I've seen in my experience when I was trading in New York was when you have a change of presidential regime, policies change drastically, and the stories that worked in the previous administration do not work in the current. And I think Celestica is a direct recipient of the Biden administration and won't be a recipient of the Trump administration. I think it was driven by fiscal spending. So that's what I would say most importantly. I think that I get emails from friends of mine who work at U.S. university investment trusts, and one was pitching me on raw data center potential land that somebody was trying to get them to invest in. And when you start seeing stuff like that, a cornfield that could be a data center because it's close to power or something, that generally doesn't work out well. That's highly speculative. That's when people are reaching. And so I think, that'll be how it ends up. Vertiv, a data center company in the US, was a SPAC, and it actually worked. But it had the right CEO, and it was the right time, and they've got a lot of operating leverage. But the stock has given up a lot now, and I think it's played out. They're still putting out good numbers, but the stocks don't always follow the numbers perfectly. They peak before the numbers peak, and I think Celestica and Vertiv and others are going to be examples of that.
Okay, so generally what you've seen so far in earnings, we've got Tesla, of course, but it's kind of in a different stream because of everything with Elon Musk. Yeah. So what you've seen from some of the technology companies, how would you characterize the start of the year for them?
A lot of uncertainty, a lot of question on whether they should keep spending money on CapEx to keep driving this AI business, and is that AI business, does it give them a competitive advantage? Because it's not quite clear, because it seems like everybody's developing the same AI models. And so this sector's still developing. I think there's a question whether they should drop their CapEx spend, but if they do drop their CapEx spend, it's going to drop their multiples because they're not going to be able to achieve the same top line growth, and we're starting to see that with Google's numbers, and I think that's how it plays out. My personal belief is the Mag 7 stocks lag for this year, maybe for a couple of years. I think they've been outsized performers for the last two. I think we know what's driven that, and I think the market's going to broaden out, and we're going to see smaller companies maybe, and more international companies, we've already seen it, be recipients of that. And so we've seen money flow into Europe when it had all flowed into the US for some time. Brazil's performing better, Asia's performing better, Hong Kong's a good performer this year. So I think we're seeing a broadening out of investment opportunities. That's healthy for the economy. And we have a backdrop, I'll get into this, this is unrelated. Like I was really excited about the last Fed announcement because they cut their reduction in the Treasury balance sheet by $30 billion to $5 billion. And to me, that's the first sign of easing. And so I'm highly attentive to the May 5th and June Fed meetings where I think they could actually cut rates again. And the market's not necessarily pricing that in, although I think in the last few weeks it's sniffing it out because interest rate sensitive stocks are starting to perform a little bit better. And so that interest rate would be levered companies, real estate companies, that type of stuff. I own Hertz. I own the warrants. Hertz is up 100% more, more than 100% in the last 5 days, 6 days. And that is a highly interest rate sensitive company because they borrow to supply their fleet of cars. And so, I think that's where you need to be right now because I see that working for the rest of the year.
Interesting. Okay. Yeah. Geoff, we got to leave it there, but appreciate you coming in and helping us sort the details for the earnings so far. Geoff, of course, is the general partner, Barratt Holdings.